to Make Money in Any Market by Jim Cramer, summarized by Detailed Book Summaries. Click on the subscribe button. Let us know in the comment the book you would love us to summarize for you. Chapter 1. Understanding the Market's True Nature and Your Role in It. Jim Cramer begins how to make money in any market by reshaping the reader's mindset about what the stock market really is. To him, the market is a living, breathing organism, one that reflects human fear, greed, confusion, and optimism far more than it reflects neat charts or perfectly rational equations. This first chapter is about clearing misconceptions. Most people believe markets rise and fall based solely on economic reality. But Cramer insists that market moves are magnified or minimized by human behavior. When people panic, even great companies trade at irrational discounts. When the crowd grows euphoric, mediocre companies can soar on hype alone. So if you want to make money in any market, bull, bear, sideways, you must start by understanding the psychology of the players, not just the numbers on a financial statement. Cramer explains that the market is essentially a battleground between long-term fundamentals and short-term sentiment. A company can deliver solid results quarter after quarter, but if fear overwhelms investors, the stock can plummet. Likewise, a weak company may rally simply because traders collectively convince themselves that a turnaround is coming. New investors lose money when they assume the market behaves rationally all the time. Experienced investors make money by anticipating the emotional waves that distort price movements. He emphasizes another critical truth. You must know who you are as an investor. Are you a long-term investor willing to hold through turbulence, or a trader more interested in seizing short bursts of opportunity? Many people lose money not because they choose the wrong strategy, but because they choose the wrong strategy for themselves. Someone with a low tolerance for risk should not be chasing high-flying momentum stocks. Someone who enjoys following economic trends shouldn't rely solely on fast trades triggered by headlines. Cramer urges readers to define their financial goals, timelines, and emotional strengths before buying a single share. Another major point in this chapter is recognizing that the market is cyclical, not just economically, but psychologically. There will always be periods where fear dominates and everything looks bleak, just as there will always be periods where optimism runs unchecked and valuations become detached from reality. The investors who thrive are those who remain steady while others lose their grip. Cramer shares that the best opportunities often appear in moments of panic, when great businesses are mistakenly punished along with the weak. But he is also clear that making money during downturns requires preparation. You cannot wait for chaos to hit before planning your strategy. He also challenges the myth of the perfect moment to buy or sell. He argues that waiting for perfection often leads to paralysis. The real advantage comes from consistency, continuing to research, continuing to buy selectively, and continuing to adjust as conditions shift. Market cycles are not predictable to the minute, but they are recognizable in broad trends. Learning how to read those trends and how to position yourself before others react is the key to longevity. Cramer ends the chapter with a message about personal accountability. Many investors blame the market, the news, or other people when things go wrong. But if you want to make money in any market, you must own your decisions. You must commit to learning, observing, and improving your strategy. The market rewards those who approach it with discipline, curiosity, humility, and courage. It punishes those who act based on tips, rumors, and emotional reactions. In Cramer's world, the market is not a lottery. It is a vast ecosystem where preparation, insight, and adaptability decide who wins. Chapter 2: The Power of Research. Knowing what you own and why you own it. In the second chapter, Jim Cramer hammers home one of his most famous principles: know what you own and why you own it. According to Cramer, this principle separates successful investors from gamblers. Too many people buy stocks based on excitement, social media trends, or vague ideas about a company's reputation. They hold stocks they barely understand and panic the moment the price dips, because they never had a solid reason for owning them in the first place. To make money consistently, especially in uncertain markets, you must research every company before you buy it. Cramer explains that proper research starts with understanding a company's business model. How does the company make money? What drives its revenue? What are the costs and risks associated with its operations? A surprising number of investors cannot answer these questions about the companies in their own portfolios. Cramer argues that this lack of clarity creates emotional vulnerability. If you don't understand a company, you can't evaluate whether bad news truly affects its long-term potential. Conversely, you might mistake hype for substance if you haven't identified what really matters in the company's strategy. He guides readers through a practical research process. First, study the company's earnings reports. These contain the most critical information: profit margins, growth rates, capital expenditures, and guidance for future performance. Second, listen to the conference calls. Cramer believes earnings calls offer insights you simply cannot get from headlines. Executives reveal confidence or doubt through their tone. Analysts ask questions that expose underlying threats or strengths. Third, review the competitive landscape. A company might be performing well today, but new entrants, technological disruption, or changes in consumer behavior can quickly erode its edge. Cramer also emphasizes the importance of industry-specific knowledge. Tech companies behave differently from energy companies. Retail stocks rise and fall based on consumer confidence, while pharmaceutical companies depend on regulatory approvals and clinical trial results. Understanding the industry context allows you to interpret news accurately. A supply chain delay might devastate one type of business, but have minimal impact on another. When you know the rules of the industry, you avoid misjudging how events influence stock performance. Another crucial part of research Cramer says, is evaluating management. A great company with poor leadership can stagnate or collapse. A struggling company can become a star under the right CEO. He recommends studying a management team's track record. Did they deliver on past promises? Do they allocate capital wisely? Are they transparent with shareholders? Strong leadership often shows up in consistent earnings growth, effective cost management, and strategic clarity. Cramer also warns readers against falling in love with a stock. Research helps you stay rational. If new information contradicts your original thesis, you must be willing to reassess, and if necessary, sell. He teaches that the best investors change their minds when the facts change. Emotional attachment has no place in successful investing. A disciplined investor constantly tests their assumptions, watches for red flags, and adapts to shifting realities. To make money in any market, Cramer says, you must treat investing as a craft, not a hobby. Thorough research not only helps you find great opportunities, but also gives you the confidence to hold steady when volatility strikes. If you know why you own a stock, you won't panic during temporary dips. If you understand the company's long-term vision, you won't be shaken by short-term noise. Research is the foundation of resilience, and resilience is the foundation of wealth building. Chapter 3, Strategy and Timing. Navigating booms, busts, and everything between. This chapter dives into the strategies that allow investors to thrive regardless of market conditions. Cramer acknowledges that no system guarantees profits every time, but disciplined strategies increase your odds of success dramatically. He begins by describing the difference between bull markets and bear markets. In a bull market, optimism fuels upward momentum, making it easier for stocks to rally. In this environment, investors can afford to take more calculated risks, especially in growth sectors. But Cramer cautions that bull markets often breed complacency. People assume prices will rise forever and start buying recklessly. The smart investor uses bull markets to build positions gradually, not to chase already inflated stocks. In bear markets, fear dominates. Stocks that deserve to fall collapse, and stocks that don't deserve to fall collapse anyway. Many investors sell in despair. Cramer argues that this is exactly when disciplined investors should seek opportunities. Bear markets reveal which companies are truly strong. Those that continue to deliver solid earnings despite economic pressure become prime candidates for long-term gains. But timing matters. Cramer explains that you shouldn't rush into falling markets. Instead, you should wait for moments of stabilization, watch for declining volatility, and build positions in stages. He introduces the concept of buying in increments, which reduces the risk of entering the market at the wrong time. Instead of investing all your money in one transaction, you break it into several smaller purchases. This strategy helps smooth out price fluctuations and reduces emotional stress. Incremental investing also allows you to reassess and adjust as new information emerges. Another key strategy is diversification. Cramer warns that owning too many stocks is as dangerous as owning too few. A well-balanced portfolio should spread risk across multiple sectors: technology, healthcare, finance, consumer goods, and so on. Diversification helps protect you when specific industries decline. But Cramer stresses that diversification does not mean buying random stocks. Each stock must still be researched carefully. It's better to own a few well-understood names than a large basket of unfamiliar ones. He also discusses the importance of recognizing macroeconomic signals. Inflation, interest rates, geopolitical events, and employment data can influence market sentiment dramatically. Understanding how these factors affect various sectors helps you position your portfolio ahead of major moves. For example, rising interest rates may hurt growth companies, but benefit banks. Economic slowdowns may pressure luxury retail, but boost discount retailers. Investors who anticipate these shifts gain an edge over those who react after headlines break. Cramer devotes a section of this chapter to avoiding costly mistakes. One of the biggest errors investors make is refusing to take profits. Many people watch their stocks rise and hold on too long, only to see their gains evaporate. Cramer recommends taking partial profits on big winners to lock in gains while still maintaining exposure. Another common mistake is chasing momentum. Just because a stock is soaring doesn't mean it's a good buy. Rapid climbers often fall just as quickly. Wise investors separate hype from sustainable growth. He concludes the chapter by emphasizing emotional discipline. Markets can swing violently, and fear or greed often sabotages rational decision-making. Cramer teaches that sticking to a well-defined strategy anchored by research, diversification, and incremental buying prevents emotional impulses from wrecking your portfolio. In his view, strategy and timing are not about predicting the future perfectly. They are about preparing smartly and managing risk. Chapter 4: Managing Risk. Protecting yourself while growing your wealth. If there's one idea Jim Cramer repeats constantly, it's that risk management is not optional, it's the core of successful investing. In this chapter, he explains how to protect your portfolio during downturns, how to avoid catastrophic losses, and how to remain confident even when markets become unpredictable. Cramer begins by acknowledging that every investment carries risk. No stock, no matter how stable, is immune to unforeseen events: economic recessions, regulatory changes, scandals, technological disruptions, or even global crises. Therefore, your goal is not to eliminate risk, but to manage it intelligently. The first rule is simple: never invest money you cannot afford to lose. Investing is for long-term goals, not emergency funds or short-term needs. He highlights the role of diversification in risk protection. A portfolio overloaded with tech stocks, for example, will suffer disproportionately when the tech sector drops. By spreading your investments, you reduce exposure to single sector shocks. But Cramer also warns against superficial diversification. Owning multiple tech stocks is not diversification. owning companies from truly different industries, each driven by unique factors, creates genuine risk reduction. Another major part of risk management is maintaining cash reserves. Many investors view cash as wasted opportunity, but Cramer sees it as strategic. Cash allows you to buy when opportunities arise, especially during downturns when stocks trade at discounts. It also cushions your portfolio during volatility. Having cash on hand prevents you from being forced to sell good stocks at bad prices just to raise funds. Cramer also stresses the importance of setting stop-loss points. A stop-loss is the maximum loss you're willing to tolerate before selling. While some investors dislike selling at a loss, Cramer argues that small losses are far better than devastating ones. A company that drops 10% can recover easily. A company that drops 70% may take decades to rebound, if it ever does. Stop losses enforce discipline and prevent emotional paralysis. He devotes time to explaining the danger of high-risk stocks. Companies with weak balance sheets, inconsistent earnings, unproven products, or heavy debt should be approached cautiously. While they may offer huge upside potential, they often collapse when markets tighten. Cramer encourages readers to distinguish between calculated risks, such as buying into a growing industry, and reckless risks, such as chasing speculative penny stocks or meme-driven rallies. Cramer also explains the value of hedging. While average investors may not use advanced hedging strategies, simple hedges, like owning defensive stocks or inverse ETFs during economic slowdowns, can soften the blow of market declines. Defensive stocks include companies in sectors like consumer staples and healthcare, which tend to remain stable regardless of economic conditions. Hedging is not meant to eliminate losses entirely, but to reduce their severity. One of the most powerful tools for risk management is knowledge. When you understand the companies you own, you can evaluate whether a stock drop reflects real danger or temporary noise. Investors who panic often do so because they lack clarity. But if you know that a company remains fundamentally strong, you're less likely to sell prematurely during downturns. Cramer argues that knowledge turns fear into opportunity. He concludes the chapter by reinforcing that risk management is the foundation upon which wealth is built. Anyone can make money during bull markets, but only disciplined, risk-conscious investors preserve and grow wealth through downturns. The goal is not to avoid losses entirely. It's to ensure that setbacks are manageable, temporary, and strategically navigated. Chapter 5: The Long Game. Building wealth through discipline, patience, and adaptability. In the final chapter, Jim Cramer widens the lens and speaks about wealth building as a lifelong journey. Markets will rise and fall. Sectors will boom and fade. Strategies will evolve as new technologies, industries, and global forces reshape the landscape. But despite all this change, the core principles of successful investing remain rooted in discipline, patience, and adaptability. Cramer begins by explaining the importance of long-term thinking. Many investors focus on short-term gains, chasing quick profits, and reacting emotionally to every fluctuation. But true wealth is built slowly through consistent investing, disciplined strategies, and a commitment to growth. He encourages readers to adopt a long-term perspective, understanding that temporary setbacks are inevitable, but rarely fatal to well-researched, high-quality investments. He also emphasizes the power of compounding. Small returns, reinvested consistently, can snowball into substantial wealth over time. The biggest mistake investors make is exiting the market after losses and re-entering too late. Cramer argues that the long-term trend of the stock market is upward. Those who stay invested while adjusting strategy carefully benefit from the natural expansion of the economy, innovation, and corporate growth. Adaptability is another major theme. What worked 5 years ago may not work today. Successful investors evolve with the market. For example, new industries like artificial intelligence, green energy, fintech, and biotechnology create massive opportunities for early investors. At the same time, traditional sectors require fresh evaluation as technology reshapes them. Cramer urges readers not to cling blindly to old ideas. Instead, stay curious, stay informed, and pay attention to emerging trends. Cramer also reflects on the emotional side of investing. Fear and greed are constant threats. To win in the long game, you must learn to control your emotions. This doesn't mean ignoring them. Fear can signal caution, and excitement can help identify potential winners, but they should not control your decisions. He suggests creating a clear investment plan that outlines when to buy, when to sell, how much to allocate, and how to react in different market conditions. A written plan reduces emotional impulsivity and keeps you grounded during turbulent moments. Another vital part of long-term success is continuous learning. The market evolves, new companies emerge, technologies change, and global events shift economic dynamics. Cramer encourages readers to stay engaged, read earnings reports, follow corporate developments, study economic indicators, and pay attention to market psychology. Knowledge compounds just like money does. Over time, the experienced investor becomes better at spotting opportunities and avoiding traps. He also stresses that long-term investing is not passive or lazy. It requires active oversight, periodic adjustments, and constant awareness. Long-term investors don't sell at the first sign of trouble, but they don't hold blindly either. They reevaluate their positions regularly, ensuring every stock in their portfolio still aligns with their long-term goals. Cramer ends the book with a message of empowerment. The market is not reserved for experts, insiders, or professionals. Ordinary people can build extraordinary wealth with discipline, patience, and sound strategy. Making money in any market is possible for anyone willing to learn, adapt, and remain committed to long-term growth. Investing is not just about beating the market. It's about taking control of your financial future, staying resilient in the face of uncertainty, and using knowledge as your greatest weapon. Let us know in the comment the book you would love us to summarize for you.